Amid the Dutch Golden Age, tulips sparked Europe's first financial frenzy. The Dutch Golden Age is at its peak, trade and wealth are booming, and one peculiar commodity catches everyone's eye: tulips. In 1637, a rare tulip bulb called Semper Augustus sold for about 10 times the annual income of an average skilled worker. This wasn't just any flower, it was a status symbol, a conversation piece at lavish parties, and soon a lucrative investment opportunity. But here's the real shocker. Within just a few months, that same Semper Augustus bulb could be worth over 10 times a craftsman's annual wage. A single tulip could buy you several houses in Amsterdam. Imagine that. This is how big the bubble had grown. So why did this happen? How could a tulip bulb become more valuable than gold? During the Dutch Golden Age in the 17th century, the rare and exotic tulips became status symbols among the wealthy. Speculators drove up prices through trading futures contracts rather than buying physical bulbs, leading to an economic bubble that eventually burst around 1637. In the early 1630s, Dutch traders began importing tulip bulbs from the Ottoman Empire, which quickly became prized for their beauty and rarity in the Netherlands. As these bulbs gained popularity among wealthy collectors and merchants, demand surged, leading to a significant increase in prices. But here's where things get tricky. Tulip bulbs do not produce a new flowering bulb each year. Instead, they often need several years to develop into mature plants capable of blooming and potentially producing offsets or new bulbs. This scarcity drove up the value even more as people competed for these rare specimens. To understand how the bubble inflated, imagine traders setting up exchanges similar to today's stock markets. People begin buying and selling futures contracts called windhandles, which are essentially agreements to buy bulbs at a future date. These contracts represent speculative bets on tulip prices rather than actual ownership of the bulbs themselves. Now imagine you're a merchant or a farmer looking for quick profits. You see others making money from these speculative trades, so you jump in as well. As more people participate, prices increase even further. It's like a snowball rolling downhill, growing larger and faster with each edition. But let's take a closer look at how this works. If you buy a tulip bulb today for 10 guilders and sell it tomorrow for 25 guilders, that's a quick profit of 15 guilders. But then someone else buys from you for 30 guilders and the cycle continues. The real danger here is that people aren't buying these tulips to plant or enjoy. Instead, they're speculating on what others will pay for them later. This creates an illusion of value based purely on the expectation of future sales rather than the bulb's actual worth. And it's not just about tulips. People also speculate on other goods like grain, spices, and artwork. The fever spreads as everyone hopes to profit from rising prices, believing that there will always be another buyer willing to pay even more. But here's the kicker: this bubble couldn't last forever. In February 1637, prices suddenly plummeted. One day, tulip bulbs were worth a fortune, and the next, they became nearly worthless. People panic-sold, trying to get whatever value they could before it vanished completely. The crash occurs rapidly, rendering many contracts unfulfillable. A bulb that was once valued at 100 guilders may be worth only a few pennies afterward. This is akin to having a contract for an asset, only to see its value plummet overnight due to mass agreement on its decreased worth. So what did people lose? Let's break it down. Imagine an average craftsman who spent years saving to buy one valuable tulip bulb. They might have set aside money that could have been used to build their home or start a business. Instead, they invested in tulips and lost everything when the market crashed. This is a lesson in how financial bubbles work and why they're so dangerous. During a bubble, investors often chase after assets that others are buying, believing it to be smart investing. However, when everyone does this, prices can rise far above their intrinsic value. When people eventually lose faith and sell off the asset, there's no floor left to prevent the price from falling sharply. Subject: the Tulip Mania, Europe's first financial bubble. Think about this. During the Tulip Mania in the Netherlands, traders would buy bulbs they never intended to plant or use, much like day traders today who speculate on stocks without holding them long-term. Both are risky bets that rely on finding someone willing to pay more later. So why do bubbles form? It's a mix of greed and fear, greed for quick profits and fear of missing out if you don't join the party. But here's the harsh truth: every bubble has its peak and eventual burst. No matter how exciting or lucrative it may seem at first, there's always a moment when reality sets in. Now let's dive into the mechanics of what happened during this mania. Imagine you're a Dutch farmer with extra money to invest in the 17th century. You decide to buy tulip bulbs instead of planting crops for next year. But here's where it gets complicated. These bulbs aren't just bought and sold, they're traded as contracts similar to futures or forward agreements. These contracts function similarly to modern derivatives, where the value is based on an underlying asset, in this case, the future price of a tulip bulb. So you might buy a contract to receive a rare Semper Augustus bulb in 6 months at today's agreed-upon price. But then someone else buys that same contract from you because they expect prices to rise further. This is where the math gets interesting. As buyers are willing to pay more for tulip contracts and sellers take advantage of higher offers, the perceived value of these bulbs increases dramatically. But here's the key point. None of this has anything to do with the actual worth of the tulip bulb itself. It's all about what people think someone else will pay later for the contract to buy or sell it. The real asset isn't the bulb, but rather the contract that allows you to trade it in the belief in its future value. So let's look at a concrete example. Suppose you buy a wind-handled tulip futures contract for 10 guilders today. If you sell it tomorrow for 25 guilders, you've made a profit of 15 guilders. Now imagine someone else buys that contract from you for 50 guilders the next day. This kind of speculative trading continues, driving prices higher with each transaction. However, eventually people come to realize that tulip bulbs are simply flowers, valuable only for their beauty and rarity, not as future investments. The market begins to cool down as fewer buyers are willing to pay increasingly higher prices for tulip bulbs with no intrinsic value. This leads to a rush to sell and recover any remaining value before the bubble bursts. In February 1637, prices began to plummet as people panicked and sold their tulip bulbs at any price they could get. A bulb that was worth hundreds of guilders one day might sell for just a few cents the next day. This rapid decline left many investors with contracts that were impossible to fulfill or nearly worthless. Now let's talk about the aftermath. After the crash, life goes on for most people in the Netherlands, but those who lost money face significant financial challenges. Imagine an average craftsman whose yearly earnings were wiped out because they invested heavily in tulip speculation and lost their savings when the market crashed. This is a powerful lesson. Financial bubbles often appear as get-rich-quick schemes, but they depend on continuous growth that eventually reaches its limit. When this occurs, the losses can be severe. It's not just about losing money, it's also about missing future opportunities due to those losses. So how do we recognize financial bubbles today? Look for rapid price increases in assets when there are no solid economic justifications to support such growth. If everyone is buying an asset simply because they believe another buyer will pay even more later, that's often a sign of a bubble forming. But here's an important point. Just because a bubble bursts doesn't mean it was necessarily bad investment advice earlier on. People who bought tulip bulbs early and sold before prices reached their peak actually profited from the trade. The danger lies in getting caught at the wrong time when everyone starts selling en masse, leading to significant losses for those holding onto assets. And this isn't unique to tulips. Every financial bubble follows similar patterns, whether it's tech stocks in 2000 or housing markets in 2008. People chase after what others are buying, thinking they'll always find a bigger fool willing to pay more later. But when everyone realizes the game is over, there's nowhere to hide. Now let's shift gears and talk about why people fall for bubbles like this. One key factor is human psychology, specifically herd behavior. People tend to follow what others are doing rather than making independent decisions based on facts or thorough analysis. Think of it like this. Imagine you're at a party where everyone starts dancing in a certain way. You might join them just because they're doing it, even if you wouldn't normally dance that way. It's the same with financial bubbles. People buy into something simply because others are buying it too, driven by herd mentality rather than intrinsic value. Another important aspect is confirmation bias. This occurs when people seek out information that supports their existing beliefs while disregarding contradictory evidence. For instance, if an investor believes tulip bulbs to be a lucrative investment, they may pay attention to reports of increasing prices while overlooking warnings about potential market downturns. These psychological factors contribute significantly to why financial bubbles form and grow. People observe others profiting and may assume it's safe to follow suit, without critically analyzing whether such gains are sustainable or indicative of an unsustainable trend. To illustrate this, let's use the historical example of the Tulip Mania in the Netherlands during the 17th century. Many people thought they could make quick profits by buying and selling tulips repeatedly. But here's the reality. Most speculators lost money over time because it relies on finding someone willing to buy at a higher price, just like day traders today who seek quick gains by buying and selling stocks frequently. So why do bubbles always seem so alluring? It's partly due to the excitement of making quick gains and partly due to fear of missing out. But every bubble eventually bursts, exposing those who held on too long to potential significant losses. Now let's talk about a specific historical case, the Tulip Mania in the 1630s. At that time, tulip bulb prices soared as investors poured money into rare tulip bulbs. People believed these bulbs would become valuable just because others were buying them. When the bubble burst in 1637, many investors lost fortunes overnight. A single tulip bulb might have been worth thousands of dollars in today's currency one day and less than $1 the next. It was like the Tulip Mania all over again, with people chasing after what everyone else was buying without considering if it made sense long-term. Another example is the dot-com bubble in the late 1990s and early 2000s. Stock prices of internet companies soared as investors speculated on future growth, often without regard for profitability or realistic valuation metrics. When the market corrected, many tech stocks plummeted dramatically, leading to significant losses for investors. The mechanics are eerily similar, people buying into something because others are doing it, without considering long-term consequences. So why do we keep repeating these mistakes? One reason is that human nature hasn't changed much since the Dutch Tulip Mania of 1637. We still tend to follow the crowd and assume trends will continue indefinitely. But history shows us time and again that every bubble eventually bursts, teaching us the importance of understanding market cycles and avoiding herd mentality. To wrap this up, here's what you need to remember. Financial bubbles can be very appealing in the short term but are inherently risky and unsustainable in the long run. They depend on continuous price increases which cannot last indefinitely. When reality sets in, prices typically plummet, leaving investors vulnerable to significant losses. So next time you see prices skyrocketing for something that seems too good to be true, be cautious. Consider whether it makes sense to invest based on the actual value and fundamentals rather than simply following what others are doing. Bubbles often look beautiful as they grow but burst with painful results. It's important to approach any speculative market with caution and critical thinking. This is educational and historical, not financial advice.